To begin, welcome to our deep dive on using high-yield savings accounts to protect and grow cash set aside for future goals. In this video, we will focus on practical steps to keep your money safe, liquid, and earning a competitive return. We will compare convenience against chasing headline interest rates, and we will outline exactly how to evaluate institutions, transfer speeds, and terms that can affect your real-world experience. By the end, you will know how to choose and set up a high-yield savings account that prioritizes federal insurance and rapid access to your funds. Next, here is our roadmap. We will start with why high-yield savings accounts matter, and then move into the absolute safety rule, federal insurance through FDIC or NCUA. After that, we will contrast the rate-chasing mindset with the importance of convenience and access. We will follow with a practical selection checklist, transfer speed considerations, and behavioral requirements to unlock top rates. We will then cover the benefits of staying within your bank or brokerage ecosystem, do quick APY math to contextualize small rate differences, compare trade-offs side by side, and use a visual decision map. Finally, we will walk through setup steps, summarize the key points, and close with a brief disclaimer. First, safety is non-negotiable. A high-yield savings account is only truly safe if the institution is federally insured, FDIC for banks, and NCUA for credit unions. These protections cover up to $250,000 per depositor, per insured bank or credit union, per ownership category. Before you deposit any money, look for the FDIC or NCUA logo on the institution's site and confirm the certificate or charter through the official FDIC or NCUA lookup tools. If the insurer is not clearly identified, do not proceed. This single step eliminates the largest category of unacceptable risk. Moving on. Understanding coverage limits and account titling is essential. The standard insurance limit is $250,000 per depositor, per insured institution, per ownership category. Ownership categories include single accounts, joint accounts, certain trust accounts, and others. Balances at the same institution within the same ownership category are aggregated toward a shared limit. That means multiple single accounts at the same bank do not multiply your coverage. To legitimately increase coverage, consider additional ownership categories, joint accounts with co-owners, or using separate insured institutions. Always verify the specific rules at the official FDIC or NCUA sites, and when in doubt, contact the institution to confirm how your titling is classified. Now let's address the rate-chasing trap. While annual percentage yield is the headline attraction of high-yield accounts, rates fluctuate frequently and are often promotional. Pursuing every extra 0.1% can push you toward accounts with clunky interfaces, slower transfers, or restrictive terms. Over time, the opportunity cost of losing quick access to your cash can outweigh the small additional interest. A more resilient approach emphasizes safety, reliability, and liquidity first, then targets a competitive rate within that subset. Next, here is your practical selection workflow. First, confirm federal insurance. If it is not insured, the decision is simple: do not proceed. Second, evaluate transfer speed and liquidity. When you need to move large sums quickly, an institution that supports fast links to major checking accounts is invaluable. Third, review any behavioral requirements to earn the advertised APY, such as direct deposits or monthly minimums. If the conditions do not match your habits, you risk earning a much lower rate. Finally, consider convenience within your existing ecosystem. If the HYSA sits alongside your checking or brokerage, you typically gain faster transfers and fewer operational hassles. Choose the account that clears all steps, not just the one with a slightly higher posted rate. Meanwhile, transfer mechanics determine how quickly cash becomes available where you need it. Standard ACH transfers can take 1 to 3 business days, while same-day ACH and certain instant payment networks can accelerate movement, especially between major institutions. Pay attention to cutoff times, weekends, and holidays, as each can extend settlement. When opening a new account, expect initial verification steps, such as microdeposits and identity checks, which may introduce temporary holds. For time-sensitive, large transfers, consider wire transfers, understanding they may incur fees. The goal is to choose providers that consistently deliver fast, predictable movement of funds. Furthermore, many top-listed rates come with strings attached. Phrases like "up to," often indicate conditions such as direct deposit, minimum monthly deposits, balance tiers, or transaction counts. If you do not meet them, your yield can drop significantly. Create a simple checklist or calendar reminders to ensure you meet the criteria each month. If the requirements are at odds with your normal behavior, choose a simpler alternative with fewer conditions to avoid surprises. Additionally, to calibrate expectations, consider the value of a 0.1% difference in annual yield. On $10,000, it is roughly $10 per year. On $50,000, about $50. On $100,000, about $100. In many real-life scenarios, the peace of mind and time saved from faster transfers and a better user experience easily outweigh this small annual difference. On the other hand, convenience within your existing financial ecosystem can be a decisive advantage. Keeping your HYSA under the same umbrella as your checking or brokerage often enables near-instant transfers, unified logins, and streamlined customer support. Even if the posted rate is marginally lower, the operational simplicity and speed can deliver more value than the small gain from a higher but less convenient account. Consequently, weigh the trade-offs clearly. On the left, a higher posted APY and promotional perks may be appealing, but they often come with unstable rates and behavioral hoops. On the right, superior access and a reliable platform translate into faster movement of funds, fewer errors, and less administrative burden. For money earmarked for near-term goals or large planned purchases, liquidity and reliability typically deserve priority over marginal rate differences. Now let's visualize the decision process. At the center is your cash goal. One branch evaluates the timeline. Under 3 months generally requires maximum liquidity. 3 to 12 months can still favor a high-yield savings account. Beyond 12 months, it may be reasonable to consider options like a certificate of deposit ladder or short-duration treasuries for a portion of funds. Another branch is insurance, which is a hard requirement. If the account is not FDIC or NCUA insured, the process stops. From there, transfer speed is emphasized, highlighting instant or same-day rails for large amounts. Behavioral requirements are assessed next, verifying that any conditions align with your habits. Finally, the ecosystem branch encourages leveraging your existing bank or brokerage setup to streamline access. The map underscores that safety and rapid access should take precedence over small differences in posted rates. Question time. Before depositing any money into a high-yield savings account, what is the non-negotiable check you must perform? Here are your options. 1. Confirm FDIC or NCUA insurance. 2. Ensure the APY is above 5%. 3. Look for a referral bonus. 4. Verify there is a metal debit card. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to confirm FDIC or NCUA insurance. Without verified federal insurance, the account does not meet the definition of a safe place for cash earmarked for future use. Interest rate, bonuses, or card features are secondary to confirm protection. Next question. If two insured high-yield savings accounts differ by only 0.1% in annual yield, what should you generally prioritize for large planned purchases? Your options are: chase the higher APY no matter what, prioritize transfer speed and liquidity, ignore both and hold cash at home, or pick whichever has the fanciest app theme. You may pause the video now to consider the options. We will reveal the answer in the following section. The correct answer is to prioritize transfer speed and liquidity. For large planned purchases, rapid access and predictability often outweigh the small additional interest from a marginally higher rate. Finally, let's walk through an efficient setup. First, confirm insurance using the FDIC or NCUA official lookup tools instead of relying solely on marketing pages. Second, open the account and complete identity verification. Third, link your main checking account using a secure method such as microdeposits or a trusted account aggregation service. Fourth, send a small test transfer to observe settlement speed and any hold times. Fifth, enable security controls and real-time alerts to monitor transfers and balances. Lastly, fund the account according to your plan, whether as a lump sum or staged deposits. This approach validates speed and reliability before you commit larger amounts. In summary, here are the key takeaways. First, insurance is step 0. Second, Small APY differences rarely justify sacrificing speed and reliability. Third, always read the fine print governing APY eligibility. Fourth, leverage your existing financial ecosystem to improve convenience and reduce friction. Fifth, test transfers and confirm holds before moving large sums. To wrap up, choose an insured high-yield savings account that enables rapid, predictable transfers. If the rate difference is marginal, convenience and access are sensible priorities. Set reminders to meet any behavioral requirements to maintain your eligible yield, and periodically reassess as your goals and the rate environment change. This steady approach protects your purchasing power while keeping your cash ready for when you need it. As a final note, this video is for educational purposes only. It is not financial, legal, or tax advice. Always verify insurance coverage and review the official terms of any account before depositing funds. If you need guidance for your specific situation, consult a qualified professional. Thanks for watching. If you found this useful, please like the video, share it with someone who is chasing rates, and subscribe for more practical money content. Tell us your high-yield savings experiences and questions in the comments so we can learn together.